This is a podcast from BFM 89.9, the business station.
7:48, Thursday, 12th of January, and you're listening to The Morning Run. Now, we shift our attention to how you should invest in this era of volatility, because after a triumphant year for stocks in 2021, I think very few foresaw the sell-off that ensued last year. And this, of course, no thanks to the Federal Reserve's aggressive rate hikes of 425 basis points. It became one of the worst years for investors, with no safe haven as both bonds and stocks were sold off in unison.
And if we consider 2023, the outlook for the global economy is increasingly gloomy, with the International Monetary Fund warning that a third of the world will be in recession. And even for countries that are not in recession, it would still feel like one for hundreds of millions of people.
So despite this adversity then, how should you position your portfolio, and what are the opportunities that exist? For some answers, we speak to Sammeer, Managing Director and Head of Consumer, Private and Business Banking at Standard Chartered Bank, Malaysia. Good morning, Sammeer. Now, 2022, volatile year for markets, with some investors ending the year in losses, even for those who have a balanced portfolio, the 60-40 portfolio. So does investing in a balanced, diversified portfolio still make sense today?
In my own career of 20 plus years, I would say 2022 has been one of the most challenging years. This is the fourth time in the last 150 years when the index, fundamentally both bond and equities, has ended in red. That's the fourth time. And the last time this happened was before I was born, actually, in 1969. So that clearly shows you this is an aberration and not a norm. And it's a rare occurrence that has happened. And we don't expect, or we don't see this to be a regular trend. So that's the first aspect to keep in mind. Now, what does it mean? That fundamentally means that diversified portfolios over decades, and there is enough data to demonstrate that, have always generated better returns, not the best necessarily, but better returns with lower volatility. So there is clearly space for having a 60-40 or a diversified portfolio. And I would rather use the word diversified more than 60-40, because as an institution, we have our own advisory framework, and we believe having a holistic or a diversified portfolio is very important for any investor when he's looking at building his investments.
The general rule when it comes to investing is to take a longer-term view, since timing is notoriously hard to do, even for professionals. But in the era of extreme volatility, does this mantra still hold true?
Timing the market is practically impossible. Right? I don't think anybody can do that. But staying in the market or staying invested, I think, is more critical and more important. A data analysis done from 1992 to 2001, if you would have missed the 10 best days of investing in the period by getting out of the market in the period for whatever reason, right? Because you were trying to time it, you would potentially lose 50% returns. And ironically, those 10 days or 7 days out of the 10 days occurred during the worst performing period of the stock market. Now, I think the bigger question, though, would be how do you decide how long do you stay invested? How much money do you put around? And for that, a simplistic framework, and the way we classify it is fundamentally to say today, tomorrow, and forever, which basically means for your needs for today, to manage your daily cash flow, your basic expenses for a living, a trip, annual holiday, and so on and so forth, which means the cash flow you need to lead your life for the next year or two, that should remain liquid. So you need to know how much money you need to put aside for a year or two, and that should remain fairly liquid. And liquid could be like CASA account for your care, a term deposit, or so on and so forth. Then you have a bucket which is tomorrow, which is basically planning for your requirements and needs for the future, which could be fundamentally your child's education, your own retirement. If you're young enough, maybe you're planning a big mega wedding for yourself or something in those lines, right? Here, the time horizon you need to keep in mind would be anywhere between 3 to 5 years or beyond, right? And the third bucket would be forever, which fundamentally means this is planning for your legacy and your immediate family at a later stage, right? Now, what that means is if you are investing, keeping in mind this framework of tomorrow or forever, you don't worry about the volatility of day, right? You're very clear that this money has been put aside for that period, which is 3 to 5 years at minimum or beyond. And hence, you're comfortable even if the markets are volatile and you remain invested. So I think that's very critical. So how do you bucket how much you want to allocate for what purpose? And that allocation will help you decide whether you can hang on and stay invested and keep reminding yourself of the objectives of why you put the money aside to begin with.
But Samir, inflation is still high and central banks are still expected to raise rates this year. So with the growing consensus of recession, how should then investors position themselves for 2023?
When you're looking at building a portfolio, the acronym we are using right now from a market outlook standpoint is SAFE. It just secure your yield. Yields are very attractive right now. So from an investment grade standpoint, the yields that you're seeing today are practically 2 times what it was 12 months ago. Right? So it's fairly attractive, right? So secure a yield, and this could be investing in investment grade bonds, or this could also be looking at high quality global equities, dividend paying equities, right? The other is to allocate some for long-term value. And here again, we're interested in Asia ex-Japan equities, or Asia USD bonds fundamentally. And then fortify against surprises. The recession likelihood is high, so clearly you need to worry about that. And you can look at gold as a inflation mitigant to some extent, right? And expand beyond the traditional means. Here, fundamentally, you could be allocating a little bit in alternate strategies. So fundamentally, that's the approach we're taking for 2023. So SAFE, S-A-F-E. Now, what is very important to remember, though, is, again, going back to your first question, having a diversified portfolio is very important. So that's a key here, right? So that's the recommendation, to have a diversified portfolio, and that depends on your risk profile again. Again, just to give you a sense from a SCB standpoint, we create diversified portfolios for clients of all risk profiles. Just to give you a sense, if you are a moderate risk profile customer, the broad allocation, and this is very high level, this is not something clients will take and execute. If they need to really invest, they need to talk to a financial advisor and understand how they build their portfolios. But a broad allocation would be almost 55% going into fixed income and about 21% going into equities. Rest about 10% in cash, some going into alternate assets like gold and stuff like that. And that's for a moderate risk profile client at this point.
Sammeer, does investing in equities typically require a higher appetite for risk?
If you want to access capital markets directly or invest directly in equities, I think there are 2 requirements here, right? One, you should be ready to take more risk, right? So that's evident. 2, more importantly, you should be capable of doing your own homework, and because you're relying on your own self to make sure you're able to go and invest. Now, the good news is today there are enough and more platforms available that give you access to that. So, for example, Stanchart, just recently, a couple of months ago, we launched our own online equity platform called Smart Stock, right? It gives you access to 12 markets, right? And you can practically access, sitting in Malaysia onshore through your SE mobile app, markets like Bursa, Singapore, Hong Kong, US, and so on and so forth. So that access is available. And we also have features like our Stock Report Plus, which is in tie-up with Refinitiv, that gives you access to more research and analysis. So what is important here is to do your homework and make sure you know what you're investing in. But clearly, given that it's DIY, and you're putting money into an asset class which is more volatile, your appetite for risk has to be higher.
Now, Samir, one consideration when it comes to investing is cost and, of course, the ease of doing so. Now, the good news is that in recent years, we've seen the onset of fintech. So is this still less of an issue, and are investors actually able to access capital markets directly?
Post-COVID, what has changed is a few things, right? So one, clients have become far more comfortable with using technology in any and every aspect of life, right? It could be accessing even a health club membership virtually nowadays to exercise at home or in your own personal gym, in your condominiums, instead of going to a health club directly. And of course, when it comes to investments, likewise, right? Accessing an advisor virtually or investing through available platforms. So that's become fairly common, and the adoption rates have been very, very high. So which is good news. Having said that, we also ran a research or a survey for about 15,000 respondents recently to ask a series of questions around their habits around investments. And one of the questions was around how do they normally like investing? And almost 69% of the high net worth clients have come back saying, hey, we do use platforms to invest, but we still rely on our wealth advisors or wealth managers to help us decide what kind of portfolio allocation, right? So that's to give you a broad sense. Now, in terms of platform access, clearly, there are enough and more available, which gives you access to capital markets, to currencies, and so on and so forth, and which makes it more convenient, definitely, to help manage your investments accordingly. So that's available. Likewise, again, I just spoke about Smart Stock as an example of a platform that we've launched, which is gives you access as a client onshore to almost 12 markets sitting in Malaysia. Likewise, we have a FX platform, similarly, right? So if you're a Malaysian who is looking to send your child, say, to study in Australia or US or UK, you would worry about how and when do you convert from ringgit to the currency of preference where you want to send. It could be in dollar, it could be in Aussie, and so on and so forth, right? Likewise for me, I'm a parent, I have young kids. They're expected to go to college sometime in the next 5-6 years, and that's a prevalent worry. So what I do personally, again, is the same thing. I use my own FX platform today, right? And I convert at a regular frequency, right? So it helps you do that at convenience at a lower cost, and it's easy. And at your own convenience, you can do it whenever you feel like. So definitely, technology is helping a lot more today, and things have become more convenient and accessible.
All right, thank you for your time. That was Sammeer, Managing Director and Head of Consumer, Private and Business Banking at Standard Chartered Bank Malaysia. This conversation is brought to you by Standard Chartered Malaysia.